We're going to jump right into it. Today we're going to talk about HELOCs. What is a HELOC? How do you qualify for a HELOC? What are the terms of the HELOC? What are the pros and the cons of the HELOC? We're going to answer all those questions today. But give me one moment. I'll be right back. As promised, HELOCs. Understand one thing. People say, what is that fancy term HELOC? HELOC. Actually, it stands for Home Equity Line of Credit. It's just the bank's way of just abbreviating the term, making it into an acronym. But listen to something that it says in the beginning, home equity. Yes, you have to be a homeowner. You have to have equity in your home. Let's start from the basics. What exactly is equity? Equity is simply what your home is worth and compared to what you pay for the home. In this situation, let's say your home 5 years ago, you bought a home in 2020. The home was $250,000. That same home in 2025 is now worth $350,000. The difference of the two is $100,000. Therefore, you have $100,000 worth of equity in your home, which means it has appreciated. Wonderful thing. Now you may say, well, how do I obtain a HELOC? You can go to banks, you can go to credit unions. Now I prefer credit unions. For me, credit unions are a preference. You may choose a bank, but that's your choice. But also remember when I tell you, if you don't tell your money where to go, you're gonna wonder where it went. We're taking away all of that today. But before I finish and begin, please hit the subscribe button, hit the like, and I want you to share this content. It simply tells YouTube, this is great information. It needs to get out to the masses, so we want to spread the message. I need you to help me do that. Have you done it? I'm waiting. Okay, thank you. Okay, as we begin. So we know you have to be a homeowner, you have to have equity in your home, and also the third thing is the bank will give you what they call a 90% loan to value, or the credit union. Now I'm going to stop here. When it comes to a credit union, when you join, all you have to do is join a credit union, your local credit union. You have to put $5 into your checking or savings account. You are thereby a member. You get all the rights and the privileges of a credit member for life. And also remember, credit unions, they work for the members and they're nonprofit. That right there is a game changer when it comes to how your money is used. But anyway, let's keep moving on. Now, when it comes to your equity, they're going to say, okay, then if the house is worth, you bought it for this, but it's worth that, you're sitting on equity, which is like a positive appreciating portion of that home loan. But let's say you went and you decided, I want to take out a home equity line of credit. Okay, then we're going to give you 90% loan to value. Let's just say, once again, example, your home, let's say you only owe $200,000 on it. It's worth $500,000. We talk about figuring the 90% loan to value. They're going to take $500,000, what it's worth, times it by 90, which means they're going to say, hey, you can actually borrow or have a line of credit up to $450,000 free and clear for you to use. Of course, you have to make those payments and all. But the beauty of a line of credit is that you only pay on the balance owed, not on the whole sum total. Remember, here is $450,000, but you only took out and drew $100,000. You're only going to pay from that $100,000. That's what they're going to calculate your your monthly payment that's due. Okay, so now we know home and equity. We know what those are. We know about the 90% loan to value. And what about qualifications? Okay, you have to at least have between a 680 and a 700. Now, my local credit union told me, oh no, if the person has like a 640 or 630, we'll look at that person and consider them as well. She said, we want to see the whole total person and how they handle paying finances. So I'll tell you right now, if you want to just try and go for it, the worst they can tell you is no, then you'll know, hey, I need to repair my credit. There are strategies. I have all of my videos talking about how to repair your credit and to run it up in record time. And then you can apply for a home equity line of credit. So for beginners, let's look at it 680 to 700. Then you won't be denied. And also make sure that your debt to income ratio is low, because one thing about this program is you cannot spend more than you make. That's going to be a no-no. You have to be disciplined to take out a home equity line of credit and use it in the way that I think is going to benefit you. Okay, so now we know. Let's consider the application process, okay? Remember, you want to research the types of credit that you want. How much do you want? How do you understand? Now you understand equity. How much equity do I have in my home? Do I want to do a 90% loan to value? Those are all things you need to talk and decide what you're going to do before you apply. Now you made that decision. And also, you guys, remember, Zillow is a great starter. Not that it's accurate all the time, but you can kind of go on Zillow and look at and see how much your house is actually worth and what the appreciation is at. It'll even tell you, hey, your house, you owe this much on your mortgage. This is how much your house is worth. You have $346,000 in equity in your home. It'll tell you that as well. So you know those numbers, you understand, and you know that. Now we're applying. When you go to apply, of course, they're going to pull your credit. It's going to be a hard pull because they know you're going for a line of credit. You're going for pretty much a line of credit from the bank or credit union. They're going to ask you for documents. Those documents are, listen, I want to see that you are employed. I need to see at least 2 months of 2 months of pay stubs, 2 years of W-2s to show that you do have a, currently employed and you have a job that brings in W-2 verifiable income. And they're also going to say, hey, now that we've gone through that, your credit score is good, debt to income ratio is good, we're going to pre-approve you. But they said, hey, listen, we need to do appraisal on that home. You may say it's worth that, but is it really worth that? So the lady told me, hey, we got technology now. We can sit there and fly a drone over your home. We can pull comps to see what the area is pulling. Once they pull those comps and that appraisal comes back, guess what? Ready to roll. You ready to sign on the dotted line. Then they're going to say, hey, don't forget, we need you to go ahead and agree to these terms. Look at all those terms. You guys read the fine print. There's certain things in there that you want to be aware of, like, when your payment is due, how much of your payment is due, what is the prime, what is the margin, all that is calculated in there. And they'll say, okay, only thing you have to pay us is the appraisal fee. When I took out my line of credit, they just told my husband and I, we need you just to pay for the appraisal. After that, everything else, we're going to roll. We're going to honor your line of credit application, ready to roll. So we got that all done. Then once you sign that paperwork, they're going to discuss with you a draw period. Typical HELOCs have what they call a 20-year payment period, which means is a 20-year term, which means that 10 years you can draw, which means you can take out as much as you want. Let's say you got $450,000 in line of credit. You can pick and pull from that. It's a revolving line of credit, like a credit card. But at the same time, they're going to say, okay, you've had 10 years of pulling. We want 10 years of paying back. Thereby, your 20-year term. 10 years to pull and pay back. 10 years, 20 years total. Okay? But also, they're going to tell you, you understand, this is what they call a variable interest rate, which means it's variable, which means there's a prime and there's an index. Now, the index is what moves up and down, the rate that moves up and down. The prime is pretty much solid. It's done. Prime would be like your 8% interest rate. The index is going to move up and down. It may be a 0.25. Well, guess what? That is going to be part of your payment. So it's going to be variable. It's going to be up. It's going to be down. And most of the times the prime is usually 1. So let's say if your interest rate was 8.25%, when you consider the plus prime, it's going to be 9.25% when you go to pay your payment every single month. But once again, because I'm teaching velocity banking, the interest rate does not even matter. I'm just giving you that for reference. So remember, it's tied to a prime and an index. The index moves up and down, and that's how they determine your total complete rate at the end of every single month. And because that index is up and down, it can vary, 0.25, 0.50. Once again, read the fine print. Okay, so guess what? We are done. We have been approved for our line of credit. We're ready to go. And for me, when it comes to a line of credit, I have videos we talk about how to use those. In this instance, we use it to run down debt. We use it to run down that mortgage, pay it off in record time. And at the same time, I always say, listen, by the time you're ready to go into that repayment period, you are fine because you've actually taken your line of credit. You've used it for what you need to use it for. You've paid it back. You picked and pulled from that thing multiple times. Now, for the $450,000 that you were approved for, remember, if your house is only worth $200,000 and you know that's what it's worth, you can actually go into what they call a first position HELOC, which means you put your house in a totally, completely pay it off with your HELOC. It goes in the first position. Therefore, you're eliminating your mortgage. So now your goal is to pay off the line of credit. And I can tell you, when you pay off a line of credit, every single month that you pay off that line of credit, your payment will go down. So what you're doing in essence is you're eliminating your mortgage completely and you're going into a line of credit. When you go into a line of credit, you throw all of your finances into that line of credit. And once again, you're running it down to pay off your line of credit. That is the beauty of velocity banking, but I think I'm getting off. I'm going to stick to this. So let's say the cons. We know the cons are, they're there. Anything you do is going to have a yin and the yang, good and bad. So the sad part about a line of credit is that if you're not responsible, you guys, because it's called equity, your home is your collateral when you take out a line of credit. So if you don't pay, guess what? It's like a foreclosure. You can lose your home. So when you want to take out a line of credit, you want to be calculating what you're going to do with it. Like I always say, if you don't tell your money where to go, you're going to wonder where it went. We're going to be direct and deliberate about what are we doing with this money. Are we investing in real estate properties? Are we investing in paying off of our current mortgage? Are we investing in completely paying for our kids' college education? Are we investing in paying off credit card debt? You make that decision. But if you falter on that, the collateral is your home. You could lose your home. That is a con, okay? Also, another con is that the value of your home were to rapidly decrease before you can actually begin to pay back your HELOC. And I can tell you, when the 2008, remember the crisis of the homes in 2008, all the predatory lending, they actually pulled back on these HELOCs. They said, hey, listen, no more draws. Your draws are over. We want you to go right directly into repayment. So that is a downside. It is tied to the economy, how well the economy is doing, and the wealth of the economy. That is the drawback, and that is a downside. So if you had it, they can come back and say, close it down. We're shutting it down. Now you have to begin to pay us back. Downside. Now that's only happened, you guys, maybe once or twice in history, but just be aware that that can happen, okay? And also, sometimes there's extra fees attached to it. If you are using it, let's say you used it, $100,000, and you paid it back, and you did it within a 3-year period, they'll make you pay typically $500 to say, hey, because the goal of a banker is they want to make money. The longer you keep these lines of credit opened up, they're going to make money. So if you pay it off before that, the 10-year period of you go back into what they call the repayment period, they're going to say, hey, you paid that off too soon. Give me $500. That's a fee. That is a negative downside. You know, you might look at $500 like, well, I don't care because I've actually paid off my mortgage. I paid off my student loans. I paid off my kids' college. I am okay with it. It's your choice, but it's only $500. So you decide how you want to do it. But that is a caveat of it, okay? But I would say, if you continue to follow the videos, I can show you how to use a line of credit to pay off your mortgage in record time. Matter of fact, to pay off your cars, to pay off your, let's say, your student loan debt in record time. You guys, I'm only telling you this because I've actually done it and it is working for me. It's called velocity banking. Okay, as we round it out and we close out the video, let's end on a high note. Let's end on the pros of a HELOC. Number one pro is, guess what? You're only required to pay on the balance that's owed per month. Let's say if you are allotted $200,000, but you only utilize $50,000, you're only required to pay on the $50,000 and not on the $200,000. So you're only going to pay on the balance that you owe regarding your line of credit. Number two is you can use a line of credit to rapidly run down your debt. You can consolidate your debt, pay it off in record time. By the way, I teach velocity banking. We pay off mortgages in record time. We pay off credit cards in record time. You can use that to consolidate and to see your debt be completely eliminated. Now, I understand you have to still pay on your line of credit, but unlike an amortization schedule, every time you make a payment on the line of credit, you see your payments go down every single month. Unlike an amortization schedule, everything is front loaded with interest, which means the banker's going to get their portion first, then they're going to apply it towards your principal. Not when we use velocity banking with the line of credit, you're going to see your debt rapidly disappear because we call it loan consolidation or debt consolidation using a line of credit. And number three is, hey, it's a rainy day fund. Can you imagine just sitting there and you have $250,000 sitting there, easily accessible to you at any point in time you need it? That's awesome. If there was a job loss, you have a line of credit, you can live off of that. Remember, don't wait till you need money to borrow money. Get it before it's ever needed because it's sitting there. It's like your rainy day fund. Now, of course, you're going to pay it back, but you have that emergency right there in that line of credit. And as I close it out, number four is, hey, with the line of credit, you now have moved yourself from an amortization schedule to a line of credit schedule. Game changer. I'm going to encourage you to follow my next video. We're going to talk all about how velocity banking in a HELOC can change your life forever. Okay? I'm Jewel, your freedom friend. I'm here until you win. Until the next video, I'll see you later.